Hi, I'm Liz Naumovski, host of Finance is Personal. Today's show is about the ABCs of financial literacy. What is a stock? What is a bond? A TFSA, an RRSP, a registered account, mutual fund fees, the difference between a robo-advisor, financial planner, investment advisor, dealing with a regulated company versus a non-regulated, and of course, risk. Now, the world of investing can be exciting for some of us, while others might find it overwhelming and challenging, especially when it comes to choosing the right investment or the advisor. Now, the reality is that there are a lot of options available as where to invest your money. It's important to understand the various investment types, their differences, similarities, and of course, become familiar with any associated fees. Joining me today to talk about financial literacy in the financial industry is Jackie Sands, Chief Compliance Officer at Caldwell Investment Management Limited. Thank you so much for coming, Jackie.
Thanks, Liz. I'm happy to be here.
Now, one of the quick questions that I want to ask you is, you look at opening up, the industry, we call it an NCAF, a new application form, right? And when you are a woman and you are opening up your NCAF, the new application form, one of the questions is, who is your husband or your spouse? Where do they work? Their age, their birthday, how much money do they make, and what are they worth?
Right.
And so many women get offended when they look at this new application form, and basically they say, hey, this is my money, this is my account. Why do you care about my spouse, who I'm living with, and what they're worth?
It's a fair question. An NCAF, or any account that you open, asks a lot of personal information. It's important to know, though, that it's very important to give this information. I'll tell you why, because when you open an account, no matter what age you are, and age matters, it very much matters, you need to plan for the future. You may be buying a home, or perhaps you're older in life and you're planning for retirement and you're not going to have any more income. It's important to understand your entire life stage, your situation. Do you have dependents, whether that's your spouse or partner, or even children for that matter, disabled or not disabled children. So the reason why they ask this information is to plan for your investment options. What's the right type of account to open given your objectives? Is there a probability that, let's say your spouse is 10 years your senior, and there could be health issues, because health costs as we age are enormous.
Right.
So the idea is to plan for liquidity in the account. What would be the right securities to recommend to you when you open this account, notwithstanding it is your account as the woman who's opening the account, but your resources could be drawn upon because of your personal situation. So it's incredibly important, as almost violating as it seems to give this personal information. You really do need to be forthcoming, no matter how old you are, whether it's in your name only or not, because your advisor, which is almost as important as your spouse, a very important relationship, needs to know everything to really service you appropriately, because they don't know what to recommend. Even if you say, hey, I'm going to save for 20 years from now, maybe you think that's your objective, but circumstances change.
Right, so there's two things that you brought up. Number one is you said age is really important, which begs the question, why is it so important?
So age matters, again, because of your life sort of stage. If you think you are, let's say you're in your 50s and you're planning for retirement, and if you say, look, I want to travel the world while I'm still healthy, then one would think your investment horizon to come up with this money is probably only going to be 10 to 15 years, because you're not traveling the world at 90 years of age or in your late 80s. So knowing your current age and what you intend to do with this account, and again, the age of your spouse, for example, medical bills may come up that you need to help pay for, is important to decide, what is my investment period? How long do I have to come up with whatever the money is that I think I need for whatever I hope to do 10, 20, 30 years from now? So age matters, as well as actually your health.
So because this is the ABC of financial literacy, you talked about liquidity.
Yes.
And there might be people out there that don't understand what liquidity means.
So liquidity is really a term to describe how quickly can you take the asset that you have, so the stock or bond, and sell it, realize it into cash. And it sounds simple, sell it, but some stocks or some investments can't be sold easily. And that could be for multiple reasons. It could be the nature of the stock itself. It could be that there are certain characteristics about it that nobody wants to buy it. Maybe it's in a company that has just been found guilty of doing some terrible things, and so everybody is trying to sell out of the stock. There are many reasons why, but liquidity is just the fancy term to say how fast can you turn your investments into cash.
Okay, so there's about a minute left to go to break, and I want to talk about stocks versus bonds.
Right.
Let's try to explain what a stock is before we go to break.
Sure. A stock, it's a term that's used interchangeably with shares. All it means is that it is your proportionate share of the company in which you have purchased. And it just tells you that you have rights to the income or the assets of that company, and you have a series of priorities of rights based on the nature of the stock. So people may have heard preferreds, commons, classes. Those are fancy terms to describe the stock as being in a series of priorities of when you get your income or when you get your assets. The important thing to know about a stock is that it's just a right. It's a right to something of this company, and the company is raising money, and so they have to pay you for you essentially giving them your money.
And you basically have ownership in the company.
It's exactly right.
And depending on the type of stock that you have, you actually have the right to vote.
That's correct. So different types of shares give you different rights. You can vote, some of them don't have voting, some of them have enhanced voting. Some of them also have a priority of claim. So for example, a preferred share, if your company went bankrupt, which hopefully it doesn't, but if it went bankrupt, when they distribute the assets after they sell everything off, preferred shareholders sort of get dibs and their allocation before the bottom, which is typically the common shares. So it's important to know how risky the investment is and which type of share or stock you should buy because it gives you rights.
And you can also get dividends as well.
Yes, and that is your proportionate share of the income that company has decided it will distribute to its investors.
Okay, well, Jackie and I will be right back after the break to talk more about understanding your investments here on Finance is Personal. Welcome back to Finance is Personal. I'm Liz Naumovski, and we're here today with Jackie Sands, Chief Compliance Officer at Caldwell Investment Management. Now, Jackie, before we went to break, we were talking about stocks, and I think we've done stocks already. So now let's move on to bonds.
Sure. Bond, much like a stock, is something a company issues to raise money, and it's really just debt. Essentially, you as the purchaser of, say, a bond, are loaning a company money. And it's just been sort of unitized, meaning you can buy it in different quantities or units. And what you're entitled to, unlike the stocks, is you're entitled to a fixed stream of income, referred to as interest, sometimes called coupons. And a bond will have a designated life. It matures on whatever period it's been issued. But unlike stocks, there is no right to vote. You don't really get any say in sort of how the company operates. But again, unlike stocks, you are more senior in the priority. So if the company did go belly up, you would get back the value, referred to as the principal value, of what you essentially loaned to the company, meaning the par value of that bond plus the interest that's been accrued.
So if I can sum it up in simple terms,
Yes.
You go to the bank to get a mortgage for your home.
Yes.
So you are in essence the bank to the company, and they are taking a mortgage from you or a loan from you.
It's essentially what it is.
I think that's an easy way of describing what a bond is.
Yes, exactly. And many different type of entities issue bonds. So people hear about things called T-bills or corporates or municipals or munis. That's just a descriptor of the entity that is issuing this debt. So municipals is obviously cities and communities. The Government of Canada has bonds. T-bill, a little different than a bond. It's very short-term maturity. So you don't get a stream of income during the period, you get it at the end, because usually they're far less than 365 days, and so it's a temporary loan, if you will, versus a bond, which could be 30-year loan. The one unique thing about bonds, different than stocks, because stocks, as everybody knows, are traded on a stock exchange.
Right.
There's no such thing as a bond exchange. There are different ways depending on what type of bond it is that you can purchase it. So government bonds are auctioned off. So usually they're sold to brokers and big dealerships who then sell it down to you and I.
The retail investor.
That's right. And then others do have organized exchanges, but they're not the stock exchange. Often they're called over-the-counter, OTC, or other sort of organized exchanges for fixed income products. That's a term to know. So stock kind of refers to all these equities and shares we spoke about, whereas bonds, T-bills, and other short-term instruments fall under fixed income. And that's because you get a fixed amount of income on top of the principal that you loaned, the amount you purchased.
So now let's talk about mutual funds.
Sure.
And ETFs.
Right.
Because mutual funds have been around for a very long time.
Yes.
ETFs have as well, but they really haven't surged up until about 10 years ago.
Right.
Is it maybe about 10 years ago or so?
The reality is, as the investors became savvy and started to understand fee structures and how they differ between a mutual fund and an ETF, a lot of individuals started moving out of the mutual funds and into the ETFs because they are essentially cheaper in terms of their fee structure. While the two are very similar, and maybe I'll step back and describe them, it's essentially a pool of money. Investors put their money into whether it's the mutual fund or the ETF, and those structures hire a professional portfolio manager to take that money and invest it in accordance with some investment objective. So a Canadian equity fund, for example. So
that means, though, a Canadian equity fund would mean that there are stocks in there without any bonds.
That is correct. So it's important to understand when you go to buy a mutual fund or an ETF that you have in mind what is your investment objective. What's your level of risk? Do you prefer bonds? Do you prefer stocks? Or the term to describe a combined portfolio is balanced. So some bonds and some stocks in there. And then the descriptors of the fund, both sets of funds are sold by prospectus. The prospectuses look a bit different, but in there will be a very good description of the strategy. How is this portfolio manager picking the assets that go in those portfolios? And what are their parameters? Does it have to be just Canadian equity, or Canadian balance, or is it global, or is it emerging markets? So there will be an entire description there, and in there as well, and this is very important, as much as it's a very big document to read, it will tell you about the risks that each one of those vehicles face. Political risk, perhaps it's in emerging markets, and there could be lots of political issues, and all of a sudden, here's the big word again, liquidity.
Right.
They can't sell the assets because some political event happens, and so now the fund becomes more illiquid. Why would you care? Well, if you want to take your money out, you want it in cash, they have to be able to sell it to give you that cash back. Now, the fundamental difference between, aside from fees, the mutual fund and the ETF is that ETFs, like a stock, are traded on a stock exchange, whereas a mutual fund is not traded on a market. You are buying a mutual fund directly from the fund company, and the fund company is taking the cash directly from you and putting it into the fund, and the fund is issuing you shares. Unlike an ETF, where ETF has a float. That's just a term to say how many shares are being traded currently on the stock market. And you are buying not from the fund company, but you are buying from someone else who's selling. So I may be selling an ETF, you may be buying it. It may happen that you're buying my units through a broker. So that's really a fundamental difference between the two. Another difference between the two is that the control of the amount of float in an ETF is really controlled by the brokers that are the distributors of the ETF. They can go back to the fund company and buy what's called creation units to increase the float. A mutual fund is issuing and taking back its units or its shares in perpetuity. So today there could be 1 million shares outstanding, but you, I, and other investors decide we want our money back, then it drops down to 500,000 shares in issue. Whereas the ETF has a fixed number that's in float, and that is being controlled by brokers and dealers who can choose to buy more from the ETF and float it. So they're similar vehicles, but the way they trade make the characteristics quite unique.
Okay, well, Jackie and I will be right back to talk more about financial literacy, and we're going to cover the fees when we come back here on Finance is Personal. Welcome back to Finance is Personal. I'm Liz Naumovski, and I'm here with my guest, Jackie Sands, Chief Compliance Officer at Caldwell Investment Management. Now, Jackie, before we went to break, we were talking about fees, or we were just about to talk about fees. So let's go in depth into fees and what the difference is, because a lot of people are invested in mutual fund, but now they're kind of going towards ETFs because the fees are lower.
Right. So fees are a bit complicated, and they're dependent on the nature of your investment and also the nature of the account in which you're holding those particular securities. So if we take mutual funds have this thing that everybody quotes called MER. M stands for the management fee, and the ER stands for the expense ratio. That's a fancy term, and they'll give you a number. It may say 3.5% is the MER. And the total, the sum of the management fee and the sum of the ER represents all of the costs that are embedded in the fund that you are essentially indirectly paying for. And the reason why I say indirectly paying for, because no investor is being levied a charge. You will not cut a check and pay these fees. Right. You're not going to get an invoice. But the value of your fund, because it's priced every day, is actually called net asset value. So they take the value of the portfolio, deduct the accrued fees every day. So you are essentially paying for it. The M is for the management of the fund. So we said previously that we hire portfolio managers to manage the assets of the fund. Right. But also other professionals are hired. You get a set of audited financial statements. You get a whole bunch of statements and a whole bunch of other documents. Well, there are people and providers and companies that prepare all of that. So the fund has to pay those expenses. Those are in either your M if the manager is absorbing them, and so they turn around and pay those parties, or they could be in the ER. And why does it matter? It doesn't really, but if you read the prospectus, you'll know what is in the ER versus the M.
Nobody reads a prospectus.
Nobody reads a prospectus.
And that's the problem.
And that is a fundamental problem, because a lot of people will say, wow, the MER is 3%, but in an ETF, it's something much lower. Maybe I'll quickly explain what the rates are in an ETF. In an ETF, you remember you are not buying it from the fund company. And you are not, although it has an investment objective, typically most ETFs that people buy are indexed or passively invested. So the portfolio manager isn't analyzing hundreds of thousands of securities and trying to pick and choose what should go in there. They're replicating the performance of something, an index. So the performance of the Toronto Stock Exchange, just as an example. So for them to do that, it is much cheaper because they're not really analyzing thousands of securities and what should they buy. they're copying, essentially, the performance of something. And that something already has a list of securities in it. So the cost to do that from a portfolio manager's perspective is much less than trying to pick out of hundreds of thousands of securities to build this portfolio. So that's one big difference. The other difference is a mutual fund, you recall I said you buy it directly from the fund company. The fund company has to keep track of Liz's shares, Jackie's shares, and Joe investor shares. That's often referred to as the registrar or transfer agency. Now the ETF is, you're not buying directly from the fund company. So really the only investors in the ETF are the dealers that took a float and then sold it on the stock market. So there's far less cost associated with keeping track of who are all these investors. So how does somebody know that Liz owns these ETFs?
Right.
That is your financial advisor. That is your dealer firm that you went to buy them. They're keeping track that you own 10 shares of this ETF. So again, that cost is actually coming from the dealer and not through the fund. So total cost is the same to you, but how it's being divvied up is quite different. So the mutual fund is an all-in beast, and the ETF is not. Now you recall I said an ETF is traded much like a stock. This is where account fees now come in. Mutual funds are not like a stock. You're buying it directly from the fund company. Typically when you buy a mutual fund, you have something called series. Remember with the stocks we talked about all the different types of securities. Same thing with a mutual fund, but with the mutual fund, the difference between the series is the fee structure. So you could be buying in something called no load, or the front end load, which is the upfront fee, is 0. That fee is the fee that goes to your advisor. Most advisors or securities dealers, however you're buying your funds, have their own fee schedule, and those are transaction fees. They may not charge for a mutual fund. And that is because in the MER, there's a component called trailing commissions. That is an amount that is paid to your dealer on the back end. So long as you own your units of this fund, a percentage of the value of those units get paid back to your advisor. So your advisor doesn't charge you directly. It's called embedded commissions. So there, you are really only paying the 3.5% I was saying before, all in. The ETF may sound, much lower, but then in your advisor, you're paying your advisor in your account fees, transaction fees, because you're trading on the stock market. So maybe they charge 2 cents a share, 5 cents a share, whatever that amount might be. So they're not comparable in terms of how the fees work, but you need, as an investor, to understand the fees, because the reality of it is you're still paying all these component parts. They're just packaged differently.
So I just wanted to mention, the trailer fees, embedded fees. There's a lot of controversy around them right now, and Canada is trying to figure out whether we keep them, we get rid of them, and that's still in the process of, I guess, negotiations or whatever.
Discussions,
discussions,
yes, and that matters because if you think about it, an embedded commission, the trailer, that amount, which is a percentage of the value of what you hold, is being paid to your dealer, your advisor. The concern is that incentivizing your advisor to keep you invested in that fund versus buying some other security or stock or bond, whatever the case may be, that might equally be in your interest, but perhaps cheaper. So that's the concern, is that because you aren't directly paying your advisor, you perhaps don't appreciate how much money your advisor is earning from you holding that investment. So that's the concern.
Okay, so we have about 2 minutes left, and there's so much more that I want to talk to you about. I think we should have done this like a 5-hour show or something.
But it's true, there's a lot to know.
Okay, so let's just quickly go through investment advisor, robo-advisor, and then is it financial planner?
Yes. So basically, when you go to buy any kind of security, you need to use an intermediary, a dealer, somebody to help you actually execute these purchases. Now, there are different types. There are for do-it-yourselfer type people who feel like, I know it all, I'm gonna read those huge prospectuses, I can make decisions. You might go to something called a discount broker. So they charge very little because essentially all you're getting is statements. Typically they're online platforms, and they give you no advice. You have nobody to pick up the phone and ask a question, oh, should I buy this ETF? Should I buy this mutual fund?
Right.
Oh my God, what do I do? The next sort of step is I need some advice. I need some help. So you can go to a dealer that has financial advisors on them or investment advisors, and those advisors can give you advice. Now, they may not trade on your behalf. You may not give them the right to trade on your behalf, but they get to know you. You're going to tell them all that personal information you didn't want to tell them so that they can recommend to you. So you're going to pay them a fee because they're giving you advice. The next level is discretion. Now, you can still use that financial advisor, but you're giving them the authority to just go ahead and make decisions for me, trade for me, and just inform me after the fact. Or, kind of like that do-it-yourselfer who likes to be online, you can still get discretion, but you can do it a little cheaper because there's no conversations, and you use a robo-advisor. And that just means an online platform where they have fixed models, and you are slotted into the model. So it is customized because what's the right model for you, but it's not really customized like the advisor. So it's cheaper. And then the last is a financial planner who isn't picking stocks, but is helping you in your total life situation. What should you do? Should you squirrel away? Should you not? Should you buy? Should you keep cash? That kind of thing. And that's the prism.
So the one quick thing I wanted to say before we go,
Yes.
because we've totally run out of time, but when I used to do the live shows on another network before, people would call in and say, I bought an RRSP. And
Right.
the one thing that I wanted to stress right now is that, you know, an RRSP is almost like a wallet. If
That's
you
correct.
think of something, it's a holding mechanism.
That's right.
So your wallet holds money.
That's right.
So an RRSP holds things for you, holds
That's right.
investments for you.
That's correct. It is an account. It's a label on an account. So you have an accordion folder. You've got one that says RSP, one that says cash, you know, all these different things, and you're deciding which investments to put in those slots in your folder.
Perfect. Thank you so much, Jackie.
My pleasure.
When it comes to choosing an investment, whether it's a stock, mutual fund, ETF, or a bond, make sure that you understand the product and what you're investing in. Don't make an investment decision because you read about it online or you heard about it through a friend. Do your homework. Be sure to ask questions and get financial advice from an expert before investing. And always make sure you know your risk tolerance. It doesn't matter how big or small your investment is. The bottom line is that it's your hard-earned money and that you have it invested for your future. I'd like to thank Jackie Sands for joining me today and you, our viewers, for watching. I'm Liz Naumovski. Bye for now.